Okay, normally the data must be released now. It's just a question of time to have the informations updated on the different website giving calendar. And I see the US dollar dropping. So we have 0.1% for the CPI and nothing for the 0.2% for the core CPI. So no significant for the core CPI and negative for the CPI. Let me just adjust the information for our members. It will take me just a few seconds. Worse than expected, and here no, for the core CPI, no significant change. And so today my bias was a weak US dollar, and so normally the US dollar should stay weak for the rest of this session. But let's go to the platform, and we can see that indeed if we observe what is happening on the US dollar pair, but also on the non-US dollar pair, we see a spike. On the euro US dollar, we see a spike of 70, almost 80 pips for the moment. On the pound US dollar, a spike of almost 80 pips. On the US dollar yen, we have a spike of, wow, 180 pips. And for the other pair, so also spike. When we have such an important news on important currencies like the US dollar, the euro, and the yen, we may have such kind of spike on many pairs. So not only the US dollar pairs. Now, because we had the negative surprise with the CPI, this means that most probably tomorrow the decision of the the Federal Reserve will be a non-aggressive interest rate hike, probably 50 basis points, probably less also. That's not inconceivable. We will see. But let me explain now the three types of movement we see when we have a big surprise. In this case, it is a negative surprise. So this means that we should see the US dollar weakening, and this is what we are seeing for the moment on the US dollar pair. So the euro US dollar, the pound US dollar are going upward, and the US dollar yen is going downward, showing the US dollar is weakening. And so when we have such a big surprise, we see three successive movements. The first movement is the spike in the direction of the news. So with weakening US dollar, it's normal to see the euro US dollar going upward and the US dollar yen going downward. So this is the first movement. This first movement can last 5 minutes or more, so it can last one candle or more. And this is the type of movement which is almost impossible to catch or to trade, because we can also observe that from the very beginning of the news, if you observe carefully the spread is pretty much large. And then at the end of the movement, the spread reduces to usually its normal value. And so if you try to catch the spike at its very start, so you will get poor price execution if your order is executed, which is not a guarantee, of course. Then the second movement will be a pullback. Let me try to take the pen. Let's see if the pen will can be used. Let me choose the color. This one. So the first movement is the spike. No, it doesn't work because the screen is constantly updated. So let's come back to my normal cursor. So the spike is the first movement. The second movement, or I can use white lines. So white lines on this chart. So the first movement is the spike, which can last several candles. Usually it will be 1 or 2 candles. After that, we will have a pullback. And we want to see a pullback deep enough. A small pullback is not enough to catch a nice trade as a trend following system. We need to see a pullback which clear approximately or at least 50% of the length of the spike. And if this is the case, after that, normally, and this pullback can last several candles. So it can last several minutes. Sometimes it can even last several hours. So we need to be extremely patient. My worst experience with that has been waiting period for around 4 hours. 4 hours with the non-farm payroll. And then the third movement will be a resumption of the trend in the direction of the news, so to the upside in this case, and this is the movement we can rather safely trade. I don't mean that we will get necessarily an interesting trade, but this is the safest movement to trade. And this is what we should observe usually. Not always, but usually. So the 3 types of movement we see with a big surprise. And sometimes there is even another movement, and this movement is not always present. It's during the 5 to 10 minutes before the news release, when the market is extremely waiting for a news release. We can see some nervosity in the market, and we can have during these last 5 to 10 minutes before the news some speculative movement, wild speculative movement. And so this is why we have a very important rule with the MAX. We never trade a news by itself, and if we have an entry setup within the last 1 hour before the news release, we skip that setup. We don't take that trade because we have no time enough to see an interesting movement. And if it is an extremely weighted news, usually the market will range. If you observe what has happened, if I widen the screen of the euro-US dollar before the news release, we can see that the price has moved in a very tight range of around 30 pips, which is a small range for a pair like the euro-US dollar. Similarly, if we are in a trade before the news release, when we achieve the limit 15 to 30 minutes before the news release, and in order to not be trapped in possible wild speculative movement, we close the trade, whatever the result of the trade will be. And then we wait for the news, as we have done presently, and after the pullback, if we have a resumption of the movement in the direction of the news, which should be the trend we are waiting for, so we can trade that movement. And if this happens, I will show you on any of the pairs we are seeing on this chart, so how the MAX handle this kind of situation. We can see that for the pound kiwi, the pullback has been already made. Now with the pair, with pair not containing the US dollar, it's not always so easy to define in which direction the pair will move with the news. But my bias analysis today was short with the pound kiwi. For the euro-yen, let me check the euro-yen, it was long. And for the pound card, it was mitigated, so not clear. So, but let's focus on the US dollar pair, because the US dollar is the most important currency. And so let's see. I like the US dollar yen today. I don't know why, but I like the US dollar yen. But we need so to be patient for that pullback. And this is why trading is boring. Most of the time we have to wait. And this is also a patience exercise, a patient discipline we must develop, we must practice, because it is a lack of patience which create often losing trades. Because many traders fear to miss some opportunity, and they believe that because they are seeing big movement, a good opportunity is present. But this is not true at all, because we never know the depths of the spike, and if you get the luck if you have the luck to be executed along the spike, you will be surprised that very often your trade will become a losing trade because of that retracement. And so let's see what will happen. Now, what is a setup? And I should say an entry setup. An entry setup is a set of conditions to have a trade. First of all, an entry setup is made of a specific pattern in the price action. And when we observe such a pattern, for example, if I look on the pound kiwi here, on the pound kiwi, if this present candle closes as a red candle, we will have a pattern for such an entry setup, a setup which will be called a REMO, a resumption momentum entry, because the trend is already to the downside. And my bias is to the downside for the pound kiwi today. So this means that we have to privilege the short trades. But having the price pattern is not enough. In order to validate the pattern, we have to check some other conditions, technical conditions. For example, do we have enough momentum and enough volatility? The volatility is evaluated on the main chart, and the other conditions are made with the other indicators we have on the chart. We have mandatory conditions and we have optional conditions, and among all these conditions we want a majority of them to be in agreement. Of course, in the max courses I teach in detail what these conditions are. And then when we have all these conditions in agreement or in favor of the setup, and if the trade is in agreement with the global context analysis, then we have a trade, and so we have a valid entry setup. We then define an entry price level and we fix a stop loss. We always fix a stop loss which will define our maximum pips risk. But of course, having a risk in pips is not enough. We have also to choose a financial risk, and by default, in my own trade, I always take a maximum risk between 0.5 and 1%. We never advise to choose a risk more than 2%. Myself, I even consider that 2% is a risk which is too large, too big. And by the way, choosing the risk per trade is a good indication for you in your own trade, if you make some tests, to see if you feel comfortable with your trade. When you take a trade with, let's say, a 2% risk, and then you get a losing trade, if you feel extremely hurt, or hurted, I don't know how to say correctly. So if you feel hurt by such a 2% risk, or 2% loss, this means most probably that this risk is too big for you. And so try a smaller risk. And the aim is to feel not too much hurt by a losing trade, because you will have losing trade. If we ignore the global context, the max has a winning rate of around 70 to 75%. Sometimes, of course, a little less, sometimes a little more, depending on the market conditions, depending on the time frame we are trading. With higher time frame, the winning rate has a tendency to increase. And so if you take a sample of 100 trades, you have to count between 25 and 30 losing trades. So you will have losing trades. And most importantly, furthermore, despite the fact that so we may have losing trades, you will face also losing streaks. A losing streak is a succession of losing trades, and you will experience that too. And the lengths of the losing streaks are always larger than what you can imagine. If you have a 70 to 80% winning rate, you must expect losing streaks made of 4 to 10 losing trades in a row. 4 to 10 losing trades in a row. And when you experience a losing streaks of, let's say, 6, 7 losing trades in a row, if you use too big risk per trade, you may face an important drawdown, or a drawdown you consider as important. And this is when the trader begin to fear what is happening and to deviate from the rules he or she is using. And so how you feel after a losing trade is a good indication for your risk level. If you take a smaller risk and if you have a full loss, if you don't feel hurt too much by a full loss, this means that the risk is appropriate. Of course, you can change the risk depending on the circumstances, depending how you feel the market. If you have a good context analysis and you feel that your context analysis is correct, which is not always guaranteed, of course, you can use a larger risk. So if you are not overconfident about your global context analysis, you can use a smaller risk than your usual risk in such a way so to mitigate the uncertainty around your trade. And so let's see when the pullback will start. For the moment, we see no pullback yet in the 3 US dollar pair. We may have a trend resumption in the pound Kiwi. And you can see that the price has already moved 171 pips from the high to the low of today, more than 280 pips for the US dollar yen. So this is why the US dollar yen is interesting. And the US dollar yen is a pair which is extremely volatile these last weeks. But we still need to be somewhat patient. And we have plenty of time. We will be in the room for around 2 hours. This is the price to pay to be, one of the price to pay to be successful in trading. So patience and following the rules, sticking to the rules. And so with a smaller inflation than forecast, so let's come back to the calendar, just a few moments to analyze a little more in detail the news. So in the calendar, we can see that not only the CPI is less than the forecast, but also less than the previous month. So this means that the inflation in USA seems to peak. This does not mean that it is reversing. This means that at least it is probably peaking. We can see that with the CPI year over year, so less than forecast and less than 1 year ago, the last month, sorry, and the core CPI similarly. So it seems that the CPI, so the inflation is slowing down. So, and this will not be a reason for the Fed to be aggressive in their interest rate hikes. Now let's come back to the platform and let's wait patiently with an entry setup. Now, once we have an entry setup which is a valid one, so we can open a trade, and once the trade is opened, we will have to handle the trade. And in order to handle the trade, so knowing when to make a possible scale-in, knowing when we have to make a possible scale-out, or when we have to close the remaining open trade, we have to consider exit setups. And an exit setup is a condition, so to close a portion of the trade or to close the entire trade. And so what is an exit setup? An exit setup is a set of conditions telling us that the risk is becoming important enough to force us to handle or to control that risk. And so we have several types of exit setup. We have exit setup based on indicators. For example, we use a momentum oscillator, which is this magenta and blue indicator in the middle zone of the chart. It is called the RSI, the stochastic of the RSI. So a momentum oscillator. We have exit setup based on pure price action. An example of such an exit setup is a long bar in the direction of the trend, because 2 out of 3 times in the Forex market, a long bar is followed by a pullback, and 2 out of 3 times is large enough to consider the possibility for an exit. We have exit setup based on a combination of price action and indicator on the main chart, and we have also time exit setup, for example, when we are facing a news release or when we are facing a specific time along the day. And then we have all these exit setup are short-term exit setup, but we have also long-term exit setup. A short-term exit setup always calls for closing one unit. What do I mean by one? Oh, let's see here the pound Kiwi. I'm going to set our max trade monitor on the pound Kiwi. So load a 1% risk. Okay, because it seems that we have an entry setup. Yeah, but I have been a bit too late. Was it a valid one? Oh, it was a valid one. That's a pity. I have missed it. Let me check carefully. Yeah, and the price has already moved by 12. So I'm too late in this setup. So when we open a trade, so let's see if we will get the next setup on the pound Kiwi. So when we open a trade, the trade is always considered as being made of 2 units. And we will handle each unit separately. When we make a scale-in, we add 2 more units to the position in order to progressively increase the position we are trading. When we make a partial exit, and we call a partial exit an MX, so a momentum exit, we close 1 unit. So for each scale-in, we add 2 units. For each scale-out, we close 1 unit in such a way to keep a position which will stay growing over time as long as we make scale-ins. And then we have several long-term exit techniques we call XXX, which consist in, when one of them happens, which consists in closing all the remaining open unit, whatever the number of open unit we have at that moment. So let's see if the price will come back at my entry level. I will place my stop loss somewhere, so in this area. There, the stop loss will be a bit too large, 61 pips, it's a bit too large. I can place it, for example, here. And if the price comes back on this level, or I can open the trade. So I will open the trade now. It's not too late. Okay, the price came back approximately to my entry level. So you can see that the trade is opened, and we have a stop loss size of around here, how many pips? 30 pips. So let me show you on the terminal panel this trade. So the size of the trade with the size of this account, which is a little more than $8,000. So the size of the trade is 42 microlots. And this constitutes, in fact, 2 units. 2 units. Each unit has a size of 21 microlots. And you will see that when I will have to make an MX, momentum exit, so I will close 1 unit. So I will not have the opportunity to make a scale-in because within maximum 2 hours, so it's extremely risky to consider scale-ins, and the best trend to make scale-in is when we catch a trade, and a trend starting around the London Open, so during the European session. And so let's see if we will have the price moving in the right direction with the pound Kiwi. It is possible, the trade is a bit risky because it is possible that the pullback is not over yet. And so this is why we must not be surprised to catch a first trade as a losing trade. And so to make an MX, I will use the MX button on my button panel, and to make the XXX, I will use the XXX panel. Now we have also a data panel which shows many data about the trade. I will explain just 2 lines, the ESL result and the XXX profit. The ESL result is in the column symbol, is the result of the trade we will get should the price hits the stop loss. So in this case, if the price hits the stop loss, we will lose 0.97%. And the XXX profit, and so this number will change when we will make an MX or when we will change the stop loss. And the second number is the XXX profit. For the moment, it is a green number, 0.10. So a green number is always changing. This is the result of the trade if we close the trade at any moment. So if I close the trade now, I will make a 0.1% profit. And so these two numbers give us the potential profit we are making and the maximum loss we can face if the price hits the stop loss. And so these are two evolving numbers depending on the way we handle the trade. And so, but they are very important because they help us to handle the trade carefully. Now, when I am in a trade, what I do very often is the following. So, I define price level which correspond to half of the size of my stop loss. The stop loss was, let's say, 30 pips. So half of the 30 pips is 15 pips. I will add also the size of the spread. We have a big spread for the pound kiwi. So 5 pips. So 15 plus 5 is 20. And so I will set a target profit at 20 pips. So here at around 191.33. 191.33. So in this area. And so if the price reaches that level, just to show how the risk will evolve, making an MX and adjusting my stop loss. So this helps to show how the risk is evolving and how the trade will become safer. So if I look on the other pair, so we see that the Euro-US dollar has not made a pullback deep enough, similarly for the pound US dollar and similarly for the US dollar yen. But the pullback is on its way. So, but now I have taken a trade on the pound kiwi, so let's focus on the pound kiwi. And this is where we need to be patient. And so why do I fix such a minimum profit level? So until a few years ago, whenever I had an exit setup on my chart, I was executing that exit setup because I am always a very risk-averse trader, very, very risk-averse. And so after a few years, having accumulated several thousand of trades, around between 3,000 and 4,000 of trades, I have decided to make a deep analysis of my trades. And I have begun to play some what-if scenario. And one of the scenarios has been the following. What my result would have been should have I ignored all the exit setup giving me a loss or not enough profit. And I have defined enough profit as a profit corresponding to half of the size of my stop loss. And then after that analysis, I have realized that my global profit would have been way, way larger. Of course, my losing rate would have increased a little bit, but not too much. And my total loss on these losing trade would have been a little larger than my previous losses, but my profit would have been way, way larger. And so this is what I call a discretionary situation when I ignore exit setups as long as I don't get a profit large enough. And this is a discretionary situation we can use provided so we feel comfortable with such a discretionary decision and we use a small risk per trade. So, okay, Francis. Yeah, it's extremely important to have a UPS power. I have myself a UPS power in case we have a blackout. So here, and the risk is very high this winter in France and in Europe to have electricity blackout. So, and my UPS gives me around 20 minutes of autonomy. So I have plenty of time to close my platform. Okay, let's see here. The price is reaching my minimum profit. So, and I will make an MX. So I have missed the MX, so let's see if the price will come back again. This is why trading with the max requires a lot of concentration. Sometimes, if you miss a small detail, you miss a good opportunity. Like myself, I have missed the MX, so here I have not been fast enough, and it's not a surprise to see the price retracing. But I don't care. I will see if I will have another opportunity. But it would have been a nice opportunity to see how the risk would have dropped. The US dollar is still a very weak currency. The Kiwi has a good strength, not the best strength, but one of the strongest currency, as it has been the case for the European session. So we can count on that effect to see most probably the price coming back lower. But you can imagine the effect on the risk. So if I close 1 unit here on my horizontal blue line, so this means that the profit on 1 unit will be equal to half of the size of the stop loss. So this means 1/4 as a reward to risk ratio. And so we should see the risk dropping at least at 0.75%. And then I will also tighten the stop loss on an appropriate place. We have specific rules to adjust our stop loss. We cannot adjust the stop loss as we want. We need to keep, depending on the volatility of the moment and the volatility of the pair, we need to keep a stop loss far enough from the price in order to avoid as much as possible to be stopped out too early with the volatility. And let me draw a white line here at the level of the stop loss just to remind the stop loss level. If I succeed to draw it approximately. No, I should not move it, of course. This is the problem with this stop loss line. Let's draw it here. Sometimes we have to fight with MetaTrader. Okay. So this white line represents where my initial stop loss has been. So, okay, Francis, good luck with your power. So hello, Ron, Randy, Alex in the private Max chat room. So now let's pay attention to what is happening in order not to miss any details. You can see that it is very easy to be distracted. Yeah, Alex, the pound Aussie is also a good pair to consider, of course, but of course I will not consider all the pairs. I have already 6 pairs on the chart. So the US dollar is again weakening. The pound is also a bit weakening. Hi, Micha, welcome. Yeah, the pound Aussie is often correlated with the pound Q, but not always. And we are for several months now in a period when the correlation is less good between the two pairs, because there are now some small differences in their respective economy. So pay attention to the less quality correlation between the two pairs. There are plenty of websites giving correlation between pairs, and so you can Google for that, and so this is something you can follow when you are in your trade. If you use a platform like TradingView, for example, which is a very popular platform now, so it's easy to show the correlation between pairs. If I see another pair moving, so I will consider also such another pair, just to have some more opportunities. More pairs we follow, more pairs we monitor, more opportunities we may have, of course. Because one specific pair may possibly not move in a satisfactory way. And so, but I'm checking on another monitor, so if I see something else on another monitor, so I will switch immediately to one of the other 5 pairs I have on this monitor. Let's see if the price will come back again on my level. And by the way, for those of you Max members who trade with the Max standard, you can see that this blue line is not also a random line. So not only it is the half size of my stop loss, but it corresponds also to an important level. You know, these dynamic support and resistance level we have in the Max. So, and we are right on this level, right on this level. And so if we have, it's possible that we have a rejection of that level. If we have a quick look on the other pair, we can see that now the price seems to begin to range on the euro US dollar, the pound US dollar. Still not enough pullback in the US dollar yen. The price is ranging on the euro yen, ranging on the pound CAD. So we need to be patient. But I'm monitoring also these pairs on another monitor just to have a look, a quick look, an easy look on these pairs. I'm working with 3 monitors, so I'm using my 3rd monitor for these 6 pairs. Now, a very interesting line we have on the chart, on the main chart, is this blue and pink line. Blue line when the price is moving upward, pink line when the price is moving downward. These 2 lines are drawn with an indicator which is called the max price channel, and it is a line when the stop loss is above the pink line. This means that we are in a down movement, and so we are handling a short trade. This line is used to progressively adjust the stop loss. Of course, for the moment, my stop loss is below the pink line, so the pink line is not usable for the moment, but you can see that with the price moving downward, this pink line drops also. And so normally, if the trend continues to go downward, we should see the pink line going below the that red horizontal line, which is my stop loss. And so this pink line will be used as a way to progressively tighten the stop loss as long as the trend will unfold. And similarly, when we are in an uptrend, we will keep the stop loss so below the blue line and following the blue line to tighten the stop loss. So let's pay attention. The price seems to come back to my level, and so if it is the case, I do not want to miss it. The spread has dropped by 1 pip, so I can adjust my line 1 pips above, so at 34, so here, and let's see if the price will come back. The Aussie US dollar should be an interesting pair today. Yeah, nice spike in the Aussie US dollar. But we still have to wait for a pullback. Why the Aussie US dollar? Because the US dollar is the weakest currency and the Aussie is the strongest currency for the moment. So this is when the trend will resume. This is an interesting pair also to consider. Let me take a small sip of water. Okay. An example of exit technique with the RSI, and this is a technique I have presented several times in our presentation webinar, is when we have a divergence between the price and the RSI. You all know what a divergence is. For example, when the price is making higher highs, let's see if we have an example here, while keeping an eye on what the price is doing. So if the price is making in an up movement higher highs and the RSI is making lower highs, so we have a divergence. This is one of the divergent type we have. We have 4 different types of divergence, and this, of course, is not a way to predict what the price is doing. What we observe is with a divergence, very often the price is making a pullback, and this is normal. Similarly, whenever the RSI makes in a down movement a bottom, a low, this indicates that the price is in fact pulling back. So the technical indicator has never a predictive power, never, never, ever. So don't try to predict what the price will do with an indicator. However, it is often easier to pinpoint a pullback in the price with an indicator than with the price itself. And the fact that the technical indicators are often, oh, my connection has been stopped. Why? Let me check. I have my internet connection, so it must be a small disconnection in MetaTrader. So let me try to re-log in. Sometimes this happens. Yeah, the connection is coming back. Okay, so because an indicator is often normalized between a minimum limit and a maximum limit, and this is the case with the RSI, which moves between 0 and 100%. So it is so easy with some specific criteria to define when the pullback becomes too much important. And this is how we consider the trade risk management. We will consider an exit setup, in fact, is a way to quantify when a pullback becomes too much important. And why is a pullback a risk for the trade we are handling? Because, of course, you see for the moment, I have a potential profit. Not a big one for the moment, because the price has not moved a lot since my entry, of course, but it is a potential profit. But whenever the price makes a pullback, a portion, possibly a large portion of this profit is evaporating, even if it is a potential profit. And the question is, what pullback lengths do we accept? And so our exit setup are all based on the same idea. What is the maximum pullback we accept before reducing the risk? So this is the concept behind our exit setup. We use several indicators, but never to try predicting what the price will do, but just to quantify when the risk along a pullback becomes too much important, forcing us to make a momentum exit, or with long-term exit technique to make an XXX, so to close the entire remaining opened trade or open position, closing all the remaining open units. And when you adopt such an approach in terms of trade risk management, your vision of an indicator is completely different. And so when an exit setup triggers, sometimes you will have to make an MX and sometimes not, depending what the price will do after your exit setup. I hope I will be able in the next 1 hour to illustrate that idea. So I see nothing else interesting for the moment in the other pairs. That's a pity. There is no the pullback yet, so it will take a long time, and probably the market will begin to range now until tomorrow with the Federal Reserve meeting. But let's see. Or sometimes the big boys take their time to decide how to handle their own position or to adjust their position. Now we have different ways to represent a price movement on our chart. The chart I'm using for the moment is a 5-minute time frame. We can trade, of course, any time frame we want, even the monthly time frame with the max. But this type of chart, whatever the time frame, is called a time bar chart. Each candle having the same time length, 5 minutes in this case. If we take the 1 hour time frame, each bar will have a time length of 1 hour. But we can use also other price representations like Renko bars, like constant range bar, like mean Renko bar, for example. We can use also tick volume bar chart. So we can use several types of representation, each one having some advantages, but also some disadvantages. And the point is, there is not an optimal price representation to trade an instrument, but some of them may have some advantage. Myself, when I trade in my live trade, so I use a constant range bar chart because the constant range bar chart so provides more details in the price action itself. in the details of the price movements. And if we have more details in the price movement, we have more decisions, opportunities for an entry setup or an exit setup. For our max standard members, so you can see that the price is moving between these two levels, which correspond also to two dynamic support and resistance level. So this means that the price is ranging for the moment between these two levels, and so any range should be broken at some point. We don't know in which direction, but because my bias for the pound kiwi is to the downside and the news has not changed my bias analysis, so my expectation is to see the trend, this range should be broken to the downside. I may be wrong, of course, because sometimes my global context analysis is wrong, or my global context analysis may be correct, but temporarily the price does not follow the context analysis. For some reason, it may be, for example, market manipulation. But sometimes I must confess that my context analysis is not correct, because I have missed information which was important for the bias, or I came to that information too late. So it is a difficult process to handle completely the global context. And what is a global context analysis? The global context analysis consists in analyzing several types of informations. The first type of information is, of course, the main driving factors of the market, the interest rates. This means the decision by the central bank. And more importantly than the interest rates, the market expectations about the next central bank decision. We all know that for the Federal Reserve tomorrow, the expectation is for a moderate interest rate increase, 50 basis points. So this makes the US dollar rather weak against the other currencies. A second set of information are what I call the geopolitical event. For example, is the situation between Russia and Ukraine still influencing the market? Is the situation between Saudi Arabia and China susceptible to influence some currencies like the US dollar, for example? Are the tensions between China and USA susceptible to change the evolution of the US dollar? And so on and so on. So this is the second type of information to analyze. So let's pay attention here for possible MX. I will try this time not to miss it. The third type of information is, so the news, okay, I make an MX. So I have made an MX, and so you can see that I have closed approximately, as I have explained earlier, 1/4 of my reward to risk ratio, so 0.26%, and you see how my global risk has dropped. This means that now, if the price makes a huge reversal and hits my initial stop loss, I will still have a losing trade, but only minus 0.22%. So I have divided my risk by almost 5. But the distance between the present price and my stop loss is 50 pips. I have an opportunity to tighten my stop loss in this case. And observe this number, minus 0.22%, which is the ESL result. Of course, by adjusting my stop loss, I will not change my XXX profit, because the XXX profit evolves with the price evolution. But by moving my stop loss, I will reduce my risk. And here, I will adjust my stop loss. I can adjust my stop loss in all this area between where it is now and this yellow moving average, which is called the momentum line, the MO line. And so if I place my stop loss at that level or just above the MO line, my stop loss will be around 37 pips. So pretty much similar to my initial stop loss. And let's do that. I will move my stop loss just above the more line, so in this point. So the stop loss has been adjusted, and you can see that now my risk has dropped to minus 0.05%. This means that I am virtually or almost break even. And when we are break even, we can completely relax on our trade. This means that even in the worst case scenario, the loss will be insignificant. If I drop my stop loss just a little bit, you can see that I am almost break even. And because the distance between my present price and the stop loss is comfortable, so around 33 pips, this means that now if I have an exit setup of any kind, for example with the store RSI, I can apply that exit setup, and if I have an exit around this area, I will be able to close my trade with a profit. Second possibility is to try to stay in the trade as much as possible until I get a long-term exit technique. A long-term exit technique calls for an XXX. It will be, for example, a trend reversal. The trend reversal is basically, not always, but basically when this slow bias green and red line at the bottom of the screen will change from red to green. So this will be a trend reversal. The trend reversal can happen in a few minutes, or it can happen in a few hours. We don't know in advance, of course. But if I try to stay in the trend as much as possible, so this is a way to catch the largest possible portion of the trend. So we have two opportunities, either to make a short-term exit and then later, if we have another entry setup, to take another short trade, or to wait until the trend reversal, or also what we call a trend exhaustion in the max standard or movement invalidation. So we have several choices to definitively close the trade, but here, due to the limitation of this session today, so I will take the next exit setup essentially here on the store RSI or on something else. So on the chart, because I have our max standard template in the other monitor I'm following through to just to illustrate that. And so you can see that the risk is now has completely disappeared now on this trade. And so once we are in such a situation, and very often when we take a profit at the half distance of the stop loss and we are able to adjust the stop loss, very, very often, so the trade will become risk-free. So we have here a risk-free trade, so almost a risk-free trade, but with a tiny, tiny loss. If I adjust my stop loss just 1 or 2 more pips, you see when it will be adjusted, so not yet. Sometimes it takes time to adjust the numbers. So these two numbers should be identical. The global number and the symbol number should be identical. The global column represents the result of the trade if we have several simultaneous trades on different pairs. I will try to see if I can. No, it doesn't change the number. Sometimes it takes time to update the numbers. Or perhaps the spread is increasing. Now here, if this candle closes as a blue candle, we can see that the store RSI will make a low. But this low will not be an exit setup, because we can see that whatever the price is doing, going downward or upward, the store RSI always makes lows at some point or makes highs. And so not all the lows in a downtrend are significant exit setup. We have also strict criteria to define when a low is an exit setup, in such a way to avoid taking unnecessary exits. This candle will close in 5 minutes, so it's a lot of time, so 4 minutes and a half. And if it closes as a blue candle, most probably it will be another, it will trigger another exit setup. So with the max standard, we have approximately 20 exit setups, short-term exit setup, long-term exit setups. Many of them are similar, so very similar. So don't believe that 20, 25 exit setup represent a large number. Many of them are similar techniques, so which reduce the complexity of these exit techniques. And so this is why when we trade a small time frame like the 5 minute, even sometimes the 15-minute time frame, we need a lot of concentration to never miss such a situation when we have either an entry setup or an exit setup. And a consequence of that is we need to remember each of the rules, each of these exit setups technique. If we want to recognize an exit setup, we need to know what the exit setup is. Of course, what I have said is just a truism. But it's a requirement to never miss an exit setup. And the way the exit setup and some indicators have been combined in the max, the beauty of that is that, let me explain in another way. You see here in this area, we have a low in the price. And so it will not be easy to understand on this chart because we have only one indicator for the exit technique. But suppose we have 2 or 3 other indicators showing also momentum. The beauty of the way the max combine these indicators is the following. If for some reason we miss an exit setup given by one of our indicators, chances are almost 100% that one of the two or three other indicators will give also on the next bar or the following bar also an exit setup in such a way that it's almost impossible to miss an exit setup in a low the price is making when we are in a downtrend, and similarly with a high. You can see that now the price is doing a nice red candle, which gives us the opportunity. We are at 50 pips from the stop loss, so this gives us the opportunity to tighten a little bit our stop loss, but I prefer to wait for the close of this candle in 1 minute and 40 seconds, just to see where the max price channel will be and if it will help. I don't think so, but we will have the opportunity to tighten a little bit our stop loss. Of course, another way to close the trade is when your total profit reaches some limit. For example, a 1-to-1 or 2-to-1 reward to risk ratio. It's up to you. So 1-to-1 reward to risk ratio will be 1%. Because remember something. Let's suppose that through one or several trades, you are able to make an average profit, total profit of 0.5%, 0.5%. And you trade every day of the year, okay? Which is not necessarily easy. Don't get me wrong about that. But let's suppose you are able to make a 0.5% profit every day, and you trade every day, and you compound your profits. At the end of 1 year, you will multiply your account by 3. With just 0.5% profit per day. If you make on average, and this is whatever the number of trades you make per day, it may be 1 trade, it may be 10 trades. And let's suppose now you are able to make on average 1% per day instead, which is a nice result. Then at the end of the year, if you make no withdrawal and you compound your profits, you will multiply your account by 10, 12. So which is a huge, huge compounding of your account. So the candle has closed. Now the stop loss is at 60 pips. I can certainly tighten my stop loss a little more, but I will be prudent and I will set my stop loss on the more line. See, now making my trade as giving a guaranteed profit, a small profit, but a guaranteed profit. Now, this candle is what we call, let me check if it is a long bar. The length of this candle is 39 pips, 22 pips. No, it's not a long bar. So a long bar is an exit setup, but it is not a long bar. But we may have possibly at the close of this blue candle an exit setup given by our Stochastic RSI. And so let's see if in 4 minutes we will have an exit setup, in which case I will close the remaining second unit. Let me show you in the terminal panel. Remember the trade size was 42 microlots. Now the remaining position is 21 microlots. And if I take in the account history, you see the trade has been closed, the unit has been closed with almost a $22 profit. So 1/4 of 0.26% exactly, a little more than 1/4 of a percent. Now, if you check on the other chart, you begin to see a nice retracement happening in the euro US dollar, in the pound US dollar, in the US dollar yen. So, which is what we have to do. So wait for significant pullback. It is not significant yet, but at least the pullback has started after around 1 hour. So it takes time. And when these pullback will be broken, you will have plenty of other opportunities to consider a trade for the rest of the US session, because now we are in the US session and we still have several hours for the US session. In the meantime, do you have some questions about what I'm presenting here? Let me check in the question panel. So if you have questions, feel free. Any kind of questions about the context, about the max. So the candle will close in 1 minute and 40 seconds. If it closes as a red candle, of course, the Stochastic RSI will not give an exit setup, but we will have another opportunity to tighten further the stop loss because the stop loss is far enough from the present price, which will help to lock a little more profit on the stop loss. And now you can see the potential profit is just 1%. So if you want to close your trade at 1% profit, so it's up to you. And you can say, okay, my day is over and I will do something else. We do not fix target profits in the max because the max is a trend following system. We want to catch a trend, a portion of the trend as large as possible. The ideal situation is to catch the trend at its very beginning until the end of the trend. And we have plenty of them along a week when we monitor several pairs. In fact, in the Max Standard course, I describe in great details a very important concept, which is called the true trend concept. The true trend concept is a specific type of trends with an interesting length, minimum 60 pips for many pairs. And so when we have a movement of more than 60 pips, 100 pips, 200 pips, so, and we are able to catch a very large portion of that entire trend with several scalings, so you can imagine the profit we can extract from that trend. We can see that in the meantime, this previous candle has closed. I can certainly tighten a little more my stop loss and I will even put it below the break-even. And now you can see that I'm locking minimum almost 0.3% profit on the stop loss, which is my horizontal red line. And so we can tighten progressively our stop loss that way. We have several rules. The general rule is to follow the pink line, so staying between 5 and 10 pips above the pink line. But we have additional rules when the size, the distance of the stop loss to the present price is way too large. We can follow the Mo line, which is this gold moving average. We can follow also this green line, which is what we call the training wheels. It is a one standard deviation Bollinger Band. So we have several complementary rules to adjust our stop loss. And you can see that it seems that my context analysis for the pound kiwi was correct. My bias since the London Open was going short with the pound kiwi, and indeed the pound kiwi has resumed, so the downtrend even before the news release on the US dollar, the US dollar CPI. And concerning adjusting the stop loss, I do that bar by bar because it is a bar by bar fight, and even sometimes a pips by pips fight until we get a risk-free trade or even a profitable guaranteed trade, which is the case here with this trade. How is your pound Aussie doing, Alex? If you are still in the room, how is your pound Aussie doing? Good? Ah, fine. You remember that my initial stop loss size was around 30 pips. Okay, this was my initial stop loss place, 30 pips. You may consider that 30 pips is large, but the risk in pips is never the financial risk. What is important is the financial risk. And we need to have, when we day trade, when we trade a trend, we have to take into account the volatility of the pair and the volatility of the moment. And so we need to have a stop loss large enough to be outside the volatility. One way to have an idea of the volatility is to observe the length of the wick and the tails of the candles. And if we have both wicks and tails which are pretty much large, then we can have an idea that the volatility is high. So we need to keep a stop loss large enough to avoid, in the case of an increase of the volatility against us, to avoid to be stopped out too early. Because in fact the risk in pips is not important at all. Imagine you have a trade with one standard lot. For example, on the pound US dollar, the pip value is $10 per lot. If you have a 30 pips stop loss, your risk is $300 for one lot, $300. But for 1 mini lot, it will be $30 because the pip value will be $1 per pip. So with the 30 pips stop loss, your risk will be $30, the financial risk. And so this shows that the financial risk depends on the trade size. And so the problem is how to choose the trade size, whatever the stop loss size, in order to have a fixed risk. For example, 1% of the trading account. And we use the position sizing concept to fix our trade size depending on an initial stop loss and the financial risk. Now we have here a long bar. This is a long bar. The length is 39 pips. And when we have a long bar is always a good exit setup opportunity if the price retraces somewhat. And I will use here 13 pips So on this level, so when we get a long bar, so we consider a retracement corresponding to one portion of the length of the bar. It can be 1/4 of the length of the bar, it can be 1/3, it can be 1/2 of the size of the bar. I like to use 1/3. So this distance from the low of the candle to my horizontal blue line corresponds to 1/3 of the entire bar length. And if the price hits that horizontal line, I will make my XXX, so which is the case now. So let's make an XXX. So my trade has been closed, of course, taking into account the spread. And you can see that I have closed my trade with a profit of 1.4%. So a nice trade, a nice result, and a rather fast trade. Consider what has happened today after the CPI report release. So a long bar is always an exit setup we have to consider, because 2 out of 3 times a long bar is always followed by a pullback. Sometimes it will be a small pullback, sometimes it may be a trend reversal, and 1 out of 3 times, so the long bar will not be followed by a pullback, but the price will continue. So in which case we call it a momentum bar. But in the Forex, it's impossible to make the distinction between a momentum bar and a non-momentum bar, because we don't have the volume information. We have only the broker tick volume, and the tick volume is not the volume. So there is some correlation between the tick volume of the broker and the real volume in the Forex, provided the broker has a very large customer basis. But this is not necessarily the case for many brokers. And so this is why 2 out of 3 times for me is a risk large enough to consider a long bar as an exit setup. So, and once the trade is closed, or while we are waiting, what we do as a max trader, we mark our chart. And so we mark our chart with a green vertical line when we have our entry setup, which was this candle, and with the entry in this area. And then we mark with magenta vertical line all our exit setup. My first exit setup was when the price has reached my minimum profit level, and then second exit setup with the long bar. And so we mark the chart. We have some specific conventions for how to annotate the chart, and then we can make a screenshot of the chart for possibly a post review of the trade. Because when we end our trading session, a good practice is to check the trade bar by bar to see if we have made an error applying the rules or not. If we make an error, so it's good to know which error we make in order not to repeat it in the future. So, okay. So the trade has been closed with a profit, a nice profit, of course with no scaling. And this 1.4 reward to risk ratio, remember my initial risk was 1%, so this represents a reward to risk ratio of 1.4, just a little more because the risk was 0.97 if you remember exactly. So with the max standard, when we have the opportunity to make scalings, we can increase the profit largely. It depends on the number of scalings, 1, 2, 3, 4, 5 scalings or more. But when we make no scaling, this is what we call our max primer level trading system, and a 1.4% or 1.4 to 1 reward to risk ratio is a good result. On average, a max primer trade will provide a profit between half and 1 R as the reward to risk ratio. And a losing trade will give a minus 0.5 R loss on average. So with 70-75% winning rate. So we have a positive expectation. And if we take into account the global context, so we may have our winning rate jumping to 90-95%. Oh, Dan, welcome. Welcome. It's a long time. We have not seen you in the room. So are you in the GoToWebinar room? Yes, yeah, you are. So glad to see you. Glad to see you. We have made a nice trade on the pound kiwi. So a nice winning trade on the pound kiwi. And so let me show you now, just before we wrap up this session, so what I do for the global context. So here on this, where is it? It is here. So I have shown the calendar, I have shown our website, new website, and this is the website we have for our members or non-members. You don't need to be a max member to use that global context analysis. So for short-term trading, so day trading, but it is not a free information. It is an information with a small monthly subscription. And I monitor 17 pairs, 6 stock market indices, 2 commodities, gold and crude oil, and 2 bonds, the US 10-year Treasury bond and the Euro bond. And I also monitor the VIX, which is the volatility index of the S&P 500. And after the London Open, when I have collected all the information I need for my global context analysis, I give a preferred direction, which we call the max bias advantage. So the preferred direction to trade for each of these instruments. Green up arrows means we have to consider long trades, and red down arrow we have to consider short trade. And you can see the pound kiwi, my bias was short, as well as for the pound yen. For the euro yen, my bias was long, but I was wrong in this case because the euro yen has dropped instead. So some of my biases may be wrong, many will be correct. So, but it doesn't matter if the bias is wrong or correct. What is important is I will take a trade only if the trade moves in the direction of my bias. So my bias for the pound kiwi was short, so I have taken a short trade on the pound kiwi. And there are 1, 2, or 3 arrows, and the number of arrows indicate the strength of the bias. 3 arrows represent the strongest bias, a rather safe bias, which is not very common. 2 or frequent. 2 arrows represent a normal bias, long or short, and 1 arrow represent a riskier bias, long or short. And whenever I change the bias, because I may possibly change, depending on the news release, I can change the bias several times a day, 1, 2, 3, 4, 5 times a day. So a timestamp is set automatically by the website, and then I save this page every day at the end of my session. So for example, if we consider the stock market, I consider that the US stock market should go upward today. Perhaps I'm wrong, perhaps I'm right. I will check at the end of the day. Gold and crude oil upward, so and so on and so on. And so this is how I consider and I use my global context, which consists of what I have explained previously, the analysis of the expectations by the big boys about the next central bank's decisions, the geopoliticals, the news releases, and the market sentiment. So the market sentiment is also important when we day trade. The market sentiment is not important when we trade higher time frames like the 4-hour, daily, weekly. But for small time frames, so the market sentiment is important, and you can have a quick idea of the market sentiment by making what we call an intermarket relationship or correlation. And this is why in what I have shown just a moment ago, let's come back again, we have the forex market, we have the stock market, the commodities market, and the bonds market. And by observing these 4 types of instrument to trade, so we can have an idea of the market sentiment. Is the market risk on or is the market risk off? And today, when we see that the Aussie and the Kiwi are strong, you can see that the Aussie US dollar minus was long, the pound Kiwi short showing a strong Kiwi, pound Aussie short showing a strong Aussie, Euro Aussie short showing a strong Aussie, and so on and so on. So this means that today the market sentiment is risk on, in fact. And when the market is risk on, this means that the big boys have a tendency to trade more risky assets, the stock market and the high betas currencies like the Aussie, like the Kiwi, possibly the CAD, depending what the price of oil is doing, and so on and so on. Okay? When the market is risk on, this means that they will have a tendency to trade less risky assets like bonds, the bond market, or in the forex market like the yen, like the Swiss. In terms of currency, possibly the US dollar. So having a view having a view on the different types of market, you may have a good idea of the market sentiment. Yeah. Of course, what I have explained today here in this trade, step by step, bar by bar, almost bar by bar, is explained much more in detail in our two courses, the Max Primer or the Max Standard. So we have two levels of the course. The Max Standard is our flagship with the entire set of entry setup and exit setup and a very sophisticated trade risk management and money management approach. The Max Primer is a small subset of the Max Standard with simplified rules, simplified exit entry, exit setup, and trade risk management. And so the Max Primer is made of 2 sessions. The Max Standard is made of 7 sessions. And both courses include also a bonus session. And during the bonus session, I show with a Forex simulator 3 kinds of situations we are facing every day. So how to handle a trade in a choppy mode, how to handle a losing trade, and how to handle a winning trade. And so all the courses are given live, but they are recorded, and the video are made available, of course, for any student who don't have time to participate live during the live session, or if you want to follow the courses on your own pace. And so you can buy the course through the video. And so if you are interested, so you can contact Craig. Craig will give you his email address. So if you don't mind, Craig, to give your email address in the chat area of GoToWebinar, so in the chat panel of GoToWebinar. So you can contact Craig. And there are also some aspects of the Max I teach in what we call mini courses. So, and most of the mini courses are available also to non-Max members. And so, but they are dedicated to some aspect of the Max. And so they will be useless most of the time if you don't know what the Max is. So a good idea is first of all to take a Max course. So feel free to contact Craig about the conditions to get these courses through video. So yeah, and Craig has posted in the chat area, in the chat panel of GoToWebinar, so his email address. So contact him for any information. So at maxtradesforyou@gmail.com. And you see here, after I have made my trade close, the next candle was a red candle, and this red candle is also a short entry setup. And so it was possible to take also that short entry setup, so opening the trade in this area. And so this would have been a second trade, possibly a winning trade, because the price seems to continue going downward. So, and so we can take several trades along the day with the same structure, initial entry, first MX, XXX, or we can try to stay in the trend as much as the trend is unfolding. But we are left with around 10 to 15 minutes so before we wrap up this session. So this is why I don't take that trade. And there is something else. You can see that this downtrend, so is a trend with a length of, for the moment, 170 pips approximately. And you have here the Frankfurt close and the London close. These two orange vertical lines represent the Frankfurt close and the London close. And I can tell you that this is perhaps with a 12% probability, the end of this downtrend. But we have a 75% probability to see this trend continue to unfold and exhaust somewhere around this Frankfurt and London close. I will not give all the details, so here, but there is a time period around the Frankfurt close and the London close when we have a 75% probability for the trend to exhaust inside that time period. 75% probability is a huge probability. 12% before, 12% after. So, and because tomorrow we have the Fed meeting, I suspect this trend is now exhausting, and the market will wait for tomorrow. So, I may be wrong, but this is what I suspect. And so, I invite you to, at the end of the US session, to observe what the price will have made based on my expectation. If it doesn't exhaust in this area, probability is high that it will exhaust in all this area. So in terms of time, not in terms of price levels, of course. And more details in the Max Standard course. Craig, you have not had the opportunity to make the introduction at the beginning of this session. Do you want to say something now before we wrap up this session? Do you want to take the mic and make some comments?
Hey, thanks, Eusebio. Really good session today. Appreciate it. Everybody, we really are grateful to you for taking time to be with us as well. We want to answer all of your questions, so if you still have one, drop it into the GoToWebinar chat right now, or if it's something you want to address later, or if you're experiencing this session by video, we welcome you as well, and you can contact me anytime with a question that might be generated as you watch the video, and we'll be glad to assist. Our next live class webinars begin in early February, but if you would like to get started during this holiday season, you can take any of our Max courses at your own pace, at your own convenience, just by using the playbacks of our course. And that works very well. In fact, Eusebio, about 70% of all Max members never attend a class webinar, and they learn entirely by video. So it's perfectly acceptable. It works very well. And of course, the content is exactly the same, and the support is exactly the same. So if we can assist you, please let us know. And thanks again for your participation. Thanks, Eusebio.
My pleasure, Craig. And yes, indeed, and this is something I would like to emphasize. Even if you take the course by video, you have our entire support, and so this means that you can ask us any questions, any clarifications about what you will learn in the video, the recorded video. So exactly as if you had taken the live course. So there is no difference for us between a student taking the course by video or taking the course live during a live session. Well, I see no further question. Perhaps a question. Is this being recorded? Will we get it as Khurshid? I hope I pronounce your name correctly, Khurshid. Otherwise, I apologize. But yes, this session is recorded, and the video will be made available. It will be sent to you. Yeah, indeed. Any session we are making, either a course or webinar presentation or an open house session, a workshop like today. So every session is recorded and made available. We have also a YouTube channel, and so the video is also posted in our YouTube channel. We are not very active on the YouTube channel because we have no time. We are traders. We are not YouTubers. So, but it is posted on our YouTube channel too. See, now it seems that we have a deeper pullback happening in the pound kiwi pair. And again, the low of this price, so here, correspond to our max template, max standard template, to a very critical level, very close to a critical level, so as a dynamic support and resistance level. So, oh, thank you, Khurshid. Thank you. Now, of course, the aim of the open house session is not to teach what the max is, but to show you some aspect of the max, just to give you an idea of the methodology we are using. But you have to keep in mind that it is an entire methodology taking into account the global context and also some very special approach using technical analysis, not to predict what the price can do, but first of all to confirm some entry setup and then to use the exit setup as a way to quantify the risk when the price is pulling back against the trade. And when the pullback is large enough, so we have to take the decision to control that risk by closing, for example, one unit. You have seen with the trade risk management tool we are using here, which is an expert advisor, how I exploit essentially the ESL result line to handle my trade when I take a profit, when I close the trade. So this is the most important criteria for me. And if you Google, you will find lots of such expert advisor making or helping you for the trade management, but I have never seen one up to now giving the remaining risk you have on your trade. They all include a stop loss size, of course. They all include a target profit and a reward to risk ratio, a potential reward to risk ratio if the target profit is reached, but I have never seen one, an easy one, showing how your risk is evolving along the trade when you close partially your trade and when you adjust your stop loss. So this is really a unique tool we use and we make available to our Max members. So, yeah, we greatly appreciate your participation today. I hope you have enjoyed this session. We are going to wrap up here now because for just a few minutes, so I don't think the market will do something interesting. I wish you a great rest of the week, a great weekend. Keep safe and see you in a next Max activity. So, thanks, Dan. Thanks, Randy, on the Max chatroom media. Really, I appreciate your comment. Yeah, I think these sessions are fun too, and especially when we see the trade going nicely in our favor. And sometimes so we have losing trade, of course, because this is how trading is. This is the trading life. So, but when we have a losing trade, we have also to embrace it because a losing trade is always a ground for the next winning trade. So, and we have to keep in mind our winning rate. And this explains. There is always a small. Just let me make a small comment about the winning rate. When we say that the max has a winning rate, let's say of 70%, this means that on a 100 trade, we have to expect 70 winning trades and 30 winning trades. But many traders make an extrapolation or a simplification, and they consider a sample of 10 trades, and they consider that on 10 trades, they must have 7 winning trades and 3 losing trades. But there is nothing more wrong than that. 10 trades is a too small sample to consider your statistics about the winning and the losing trades. You have to consider a larger sample, 100, 200, to have realistic number. And on a sample of 10 trades, it may happen that you will have 10 losing trades in a row. And so never be misled and never underestimate the winning streaks you may have. And this seems something paradoxal. Many traders accept the long-term statistical result, 70% winning rate, but they are horrified when they get to 3 losing trades in a row. They do not understand why this happens. So, because they make a confusion between the short-term and the long-term perspective. When we talk about statistics, it's always a long-term perspective. So, how long will this trade run? It depends, Koshai. This trade has run for from the open to the exit for 11 bars, so 55 minutes in total. So the trade has run for 55 minutes. Now, each trade has its own time length, and so we cannot predict in advance how long a trend will take. It may be 15 minutes, it may be 5 hours. Okay, when it is a trade of 5 hours with a nice trend, then we may have scaling opportunity. So it depends on each other. But this one has lasted so 55 minutes. Okay. You see here this small red arrow indicates our entry level after the news release. So it is a small arrow pointing to the right. This first red arrow pointing to the left is our first exit. And the second red arrow pointing to the left is the last exit, the second exit. So an entry, an MX, and an XXX. Okay? I mean your exit point, my exit point. I don't really understand your question. How long I trade, do you mean? How long I trade? Personally, I trade between the London open and the London close. So it's a 9 hours period, rarely more. And so, if the, the exit point. If I stay in the trend as much as possible, as long as the trend unfolds, my exit point will be the end of the day. I never keep open trade overnight, because we may have overnight gaps. So sometimes it happens. It's not frequent, but sometimes it happens. Most of the time, in 75% of the case, so the trade is closed around that period I have mentioned, around the Frankfurt and the London close. Depending on an exit setup, we see in that time period. Okay, I hope this answers your question, Khurshid. So it depends how the trend is unfolding. Because remember, we try to catch the largest possible portion of the trend. And you can see here now, this green red line we call the slow bus is turning to green. And so the trend is reversing. And this blue candle is indeed now a long entry setup. But this long entry setup does not give a valid trade because the global context for the pound kiwi is to the downside. And so I will ignore this long trade. This means that trading the pound kiwi for today is complete. So there will be no other opportunities, significant opportunities on a pair like the pound kiwi. The best sessions to trade a pair is always the sessions indicated by its currencies. The pound is a European currency, the kiwi is a Pacific currency, so the European session and the Asian session are the two best sessions to trade this pair. The US session, especially the second part of the US session, is not ideal to trade such kind of pair. There are 3 European currencies, the euro, the pound, and the Swiss. 2 American currencies, the CAD and the US dollar, of course, and 3 Pacific currencies, the yen, the Aussie, and the kiwi. Okay, thanks, Khurshid. Okay, so again, so we will wrap up here. Again, thank you very much for your participation today. So again, I wish you a good rest of the week. Pay attention tomorrow with the Fed meeting. We may see some volatility in the market in case of an unexpected movement by the Fed. Keep safe, and see you in the next max activity of any kind. So, and in the meantime, take care. Bye everyone.